Welcome everyone. Today on the Joseph Carlson Show, Duolingo, the stock that's on everyone's mind. It's down a staggering 29% on the day. The stock price is being obliterated. And why is that? Well, the stock is obviously being re-rated because investors are now concerned about its future deceleration in growth. Now, anytime a highly rated stock, one that's trading at a higher multiple, has any concerns with its growth, investors sell out of the stock, they rate it much lower. And that's what we're seeing happen here. So this is clearly a re-rating event. And this is something that I have a little bit of experience with in the past with Netflix. That was another stock that concerned investors for a time, and investors quickly re-rated the stock to a much lower multiple, causing it to fall 75% from the highs. So given this situation with Duolingo, what do? Do we sell out of the position? Do we accept our losses, do some tax loss harvesting and move on? Do we hold the position? Do we buy more and double down? There's a number of options available to investors in these situations. And what investors do in these specific scenarios, in these exact situations where a stock like Duolingo sells off dramatically, what we do now can in many cases determine your future returns to a huge extent. So we'll be talking about Duolingo, and I'll be going over some of the fundamentals of the business as well as commentary from the management. Management held an earnings call yesterday that I will admit was one of my favorite earnings calls ever. It was incredible to listen to, the vision of this management. And I want to go ahead and highlight some of the things that the CEO said on this call. So we'll be looking at everything. We'll be looking at the portfolio, the position sizing, all of the damage being done by Duolingo. We'll go over all of it. Now, of course, we have other news to get to. Google is on the move again. It's one of the rare stocks that at least right now is in the green on this red day. Google is by far my largest position. It's one that I'm very proud to have as my largest position because like I've said many times, I've never seen so many good things going on with a single stock. It's incredible. And this is just one more thing to add to the list. Google is now rolling out its most powerful AI chip, taking aim at NVIDIA with custom silicon. This company's doing it all. It's just doing it all. We're gonna be looking at Google's advancements. And then finally, we've already had a fail of the week this week, but we have a second one, so that's two fails of the week. And in this case, it's going to be Chipotle. Chipotle is struggling. Unit volume is going down. Customers are frustrated. And one of the primary reasons is the inconsistent portion sizes. Sometimes you get a big burrito, sometimes you get a small burrito. You never know. It feels like a gamble going to Chipotle. And in this episode, I will be fixing Chipotle. I have the solution. I have the answer. I can fix this company and get it back on track. We'll be going over that fix. So we have a ton to get to in this episode, a lot to go over. We're going to be jumping into all of it. Just a quick mention before we jump in. I have launched Qualtrim Direct, meaning that you no longer need to go to Patreon to sign up for Qualtrim and join the Joseph Carlson Show Discord community. Now, this is a great value because you get both Qualtrim.com, full access to it, the entire website, all the benefits, all the bells and whistles for $10 a month. And you also get the Joseph Carlson Show Discord included with that. So there's no upsells, there's no cross-selling, it's all just one thing. And you can sign up directly on Qualtrim.com without ever using Patreon. Now there's two different plans. One of them is $10 a month. You get a free trial, a 7-day free trial. The other one, if you really love the service, you can pay $8.25 a month on average, billed once a year. So this is the annual plan. Either way you pay, it's dirt cheap. We now have above 11,000 users. In the past week alone, we've had 800 people sign up. So I appreciate everyone for trying it out. And the reviews have been overwhelming. I mean, it's awesome to hear people's great experiences with the product, saying, this is amazing. I've tried it out. It's exactly what I've been looking for. We're getting a lot of that. So I appreciate everybody and hope you have a good experience with it. Now, let's go ahead and jump in. The first thing I want to mention with Duolingo is we can look at my position sizing because this isn't just some stock. This is one that's in my portfolio. Now, it's in the story fund, and here we have it. If we look at the story fund, this is a little bit more of an aggressive portfolio, so to speak. In general, these stocks are more volatile, they're more aggressive, they're faster growing. And you'll also notice a theme that they're almost always subscription-based companies or they're data companies. They offer products that people use for a very long period of time. So they're not very transactional companies. These aren't ones that you have an experience with once and then you leave. So they're not like car companies. These are companies where you live with the product. You use it all the time. It becomes part of your daily routine. Think about the fact that Amazon is a product that is a part of my life. I have immense lifetime value with Amazon. Netflix as well. I think I'm going to have a membership for the rest of my life. Same with Google. I use their products every single day, all the time. Microsoft, the same thing. Then we have S&P Global. This one is a bit different because it's more detached, but it is ingrained and embedded in all of the markets. But then we have more of this with Duolingo. This is another stock that, despite the volatility, despite the fact that the stock price is all over the place, this is a company that people use all the time. 50 million people are using this every single day. 50 million a day, and even more on a monthly basis. Now, the thing that I want to highlight with Duolingo, before we even get into the analysis of what's going on and what I plan on doing, is I want to emphasize one point, and that is position size. Duolingo has always been a small-sized position, and the reasons for that were intentional. I intentionally put it as a smaller position because I recognize the inherent risk and volatility in the company. It is a small company, meaning that it has higher levels of volatility. Smaller levels of capital move the stock more, either up or down. That increases the amount of volatility, which in many cases increases the amount of risk. Because when stocks go up 50% or down 50%, it can become much more difficult to hang on to that company. So volatility was part of the reason that I kept it as a smaller position. Another reason why is because the company is less established than many other positions. For example, no one can reasonably argue that Duolingo has a much more proven moat and proven business model than Google, Netflix, or Amazon. You just can't. Google, Amazon, and Netflix are just way more proven stocks. They're more at a steady state. They're more mature. Now, Netflix 10 years ago, then you could argue that they're on par with each other. Netflix 10 years ago was a bit more dicey. It was a bit more risky, so to speak. But that's where Duolingo is now. It's earlier in its arc. The probabilities, the outcome distribution is wider than these other companies. Now, having said that, I've taken in all of these risk factors and I assessed that this stock needed to be a smaller position. And I sized it as a 2% position. Let's go ahead and just take a look at how this looks. On Qualtrim, I can look at my passive income portfolio and the story fund, or I can look at them combined. So let's go ahead and just take a look at them combined for a minute. We have here at the top, Google. Google is a 13% position. A lot of that is growth. Google stock has grown to $72,000 in gains, not counting dividends paid. And then the rest of it is deposits. I've deposited into Google. I've purchased myself over $100,000 of Google stock. So an enormous amount of money has been spent on Google at all varying stock prices because I'm so bullish on this company. But Google's also grown with $72,000. So it's roughly a $172,000 position. Now we also have Amazon 11%, S&P Global 9% or 10%, Netflix 10%, and all these companies have made massive gains. Then we scroll down the list. We have all these holdings, 6%, 8%, 5%, 4%, 3% for Equifax. Even Texas Roadhouse, which I sold off half my position, is a 3.2% position. Right now, Duolingo is less than a 1% position. Now, that's partly because it's sold off by half the position. It's down $11,000. Before this company sold off, it was a 2% position. So it went from 2%, it's down 50%, now it's at a 1% position. Meaning the total impact on my portfolio, the NAV of my portfolio was dinged by 1% because of Duolingo's underperformance. Now, I'll admit, having a 1% hit to my portfolio is not fun. I want every single stock I make to be a successful one. I try hard to make good investments. So it's not good. I'm not celebrating that the stock is down 50% and that it's a 1% hit to my portfolio. But the reason that I bring this up is because it's important to look at position sizing. A lot of times when we look at other people's investments, we just see a list of holdings. But looking at how much money they have in every holding is incredibly important. For example, the total amount that I've put into Duolingo myself is $20,000. That's what I've contributed. So the most that I can lose on the stock is around $20,000. Now, with Google, I've contributed 5 times that amount. So it's a $100,000 contribution to Google. So Google's over 5 times the size of my contribution to Duolingo, and that represents my levels of conviction in these stocks. Now, that shouldn't be interpreted as me being bearish on Duolingo, but I just believe that it's deserving of a smaller amount of capital. I think that's prudent investing. And I've highlighted this before today. This is something that, again, I've been saying for months. 3 months ago, I said it's fair to say that a much smaller market cap, higher volatility, a thesis more heavily dependent on continual high growth rates, and only a partially proven durable moat are all factors in the smaller size position for Duolingo compared to other more established companies. That's what I wrote on my Discord a couple months ago when I was continually asked about why the stock is such a small position in my portfolio. So I've had experience with stocks dropping. In fact, I've seen re-rating events like this happen before firsthand, one time with Netflix. Years ago, I had Netflix as my top position. Netflix was a stock that I was so bullish on, I couldn't even contain my excitement about the company. I made video after video about the stock. You can go back and look at this very channel, look at around 2020, 2021, 2022. That's where you'll see a lot of content about Netflix. Netflix ran into troubles with future expected growth. They said that they're not only not growing with subscribers, they're actually churning. They're going to lose some subscribers. They're going to lose about 1 million subscribers. Wall Street didn't like that. The stock price valuation was rated and dependent on continued fast future growth. When Netflix indicated to investors that growth is going to be upset, that growth is going to be much slower than expected, that they may not even have a total addressable market to grow into, investors became incredibly bearish on the company incredibly fast. And in many cases, this can catch you off guard. It did with me. I didn't know that Netflix is going to sell off 75%. After all, I had it as my largest position. So Netflix began to sell off quarter after quarter, 2 consecutive quarters, and it sold down 75% from the highs. My top position was completely obliterated. Now, that was really stressful. That was not a fun thing to have happen. And ever since then, I've been careful when I invest in companies that are dependent on continued high growth rates, ones that have a lesser established and more volatile story. In that case, Netflix was my biggest position. So that was a pretty tragic event for my portfolio. In this case, Duolingo is my smallest position. It is not a tragic event. This isn't something that's really going to impact the portfolio performance over the long term. It is so far a 1% ding to the portfolio. Now, in any case, I don't like it when my stocks go down. I want all my investments to do well, including Duolingo, including even my small positions. I put the $20,000 into this stock because I want to make money with it. So let's go ahead and just take a look at the situation that we're in. The stock is being re-rated. It's down 30%. And these type of sell-offs happen for specific reasons. They happen because investors have determined that this company no longer deserves the premium multiple that it once traded at. So they re-rate it down to a lower rating. The most common reason why is because this company is dependent on high growth. Investors have outlined and underwritten high amounts of growth, revenue growth of the company. And so far, Duolingo has delivered on that revenue growth. You can see the very fast revenue growth. It growing 41%. It continued growing in the future. But Duolingo gave investors a reason to be concerned that growth may be decelerating. And that was in their earnings report. In their earnings report, they go over everything, but I want to skip to the 2025 outlook and beyond. When we look at the 2025 outlook, they have something here called bookings. The Q4 bookings, so next quarter, to grow 22% year over year, or 19% on a constant currency basis at the midpoint. Now, why is this important? It's important because Wall Street believed that they were going to grow their bookings at around 24%, which is more than what they said they're going to grow. So Wall Street's saying, oh, wow, not only did they not meet their booking estimates or exceed it, but they didn't even come close. They're below what we expected them to grow. And so we see a company that's growing slower than expected. Now, what is the booking growth? The booking growth is like the amount of subscribers and the amount of revenue they're gaining that's amortized over a year. So a way to think of this is right now, the revenue that Duolingo is receiving this quarter is bookings they got last year, meaning that the bookings they get this year is going to be the revenue they receive next year. So bookings are a preview of the future, and the preview of the future shows revenue slowing down. When a company's priced at a premium multiple and revenue slows down further than expected, you get stock prices re-rated. So that is the single reason the stock is down today. It is that booking number. Now, if we look at other things, I think there's actually a lot of positives in this report, and I want to go over a handful of them here. If we look at the overall subscription revenue of the company, it is growing incredibly fast. In fact, the subscription revenue grew by 45%. Subscription revenue makes up around 90% of their total revenue because they are a subscription-based company. What I see here with this most recent quarter is incredible economics. You have a company that is growing the subscription base over time. These users are also falling in love with the product, using it every single day. And we see that in the other numbers. For example, we have the monthly active users. This was a big scary point just a quarter ago. Remember, a big problem with Duolingo a quarter ago was that their monthly active users actually declined. It declined. Oh no, everybody was concerned about the monthly active users going down. Will it ever grow again? Was this because AI is eating away at Duolingo's moat? Was this because Google Translate is now stealing customers? Well, this quarter proved that wrong. It continued to grow even past where it was in Q1. The growth of the monthly active users is up 20% year over year, and now they have 135 million monthly active users. So I'm personally very happy to see this continuation of this trend. I thought that it would continue back upwards, but there was no guarantee. There was a chance that the monthly active users could come in below where it was last quarter, that it could continue on its decline. And we don't see that. So that's good news for the Duolingo shareholder. Then we have the daily active users. These are people that log on and do a lesson every single day. Every day of the month, the entire quarter, we have it right here. It's now past 50 million daily active users. We look at this and it went from 47.7 to 50.5. Now this level of engagement, having 50 plus million daily active users, surpasses many top social media companies. A lot of them do not have 50 plus million daily active users. So I like seeing this growth as well. We see the paid subscribers. The paid subscribers also grew by 34% year over year. Now they have 11.5 million. That's a bump up from 10.9 million the quarter before. We see continued growth, all the charts going up and to the right. So that's what we see with Duolingo. All of these charts are moving in the right direction. One thing that didn't move as much as investors may have expected is the paid subscription penetration. But that is for specific reasons. The management noted that they're not focusing on that right now. And this is part of the concern of this quarter. Management basically said that their main focus has shifted. It's shifted away from turning the screws of monetization and making more revenue to now going for a big opportunity. And the CEO highlighted over and over again the opportunity that they're going for. I want to play some clips of the audio just from this most previous earnings call of Lewis, the CEO of the company, talking about the opportunity he sees ahead with education.
Yeah, I mean, look, we're like you said, and like I said in the shareholder letter, there's a huge opportunity right now. We see a huge opportunity over the next few years. Education and the way people learn they're going to change fundamentally, and it's because of AI, and also because of AI, we have line of sight now to create an app that can teach really, really well, much better than anything that humanity has seen before. As good as a human tutor, but that is also more engaging. And if we're able to do that, right now we have, I don't know, we just posted 135 million monthly active users. If we're able to do an app that teaches just that well, much better than we have now, we would be talking about billions of users that we have. And that's what we want to shoot for here. So this is why we are investing in the long term. And what that looks like is that we are putting more relative investment in things like teaching better, which, teaching better, if we teach better, what that does is that helps user growth. But there's a lag. Just whenever you improve your courses, users do grow, but it takes a while for that to happen. And then user growth, there's a lag to get to monetization because people take some time to subscribe. So this is kind of a long-term thing, but we're very bullish on this, and this is why we're doing that.
He talks about how they're in the low 100 million users, and his ambitions are to get to billions of users. And he mentions this opportunity again throughout the call multiple times. I want to highlight one more time where he talks about this.
As to why now, it's a great question. The reality is that over the last couple of years, it has just become progressively clearer and clearer that we are in a unique point in time, particularly with education, in terms of how education is going to happen in the world, and also how well we can teach at Duolingo. We just see it in our own metrics, in how fast we can put out content with things like video call. Do we just see how much it is improving every month? And so that just kind of has been coming for a while. And what has happened is that over the last month or two, I've really rallied the company towards this shift.
The CEO has come to the conclusion that we're at a very unique moment in time where the landscape of education is shifting dramatically. He has this big opportunity to grow into this category of making Duolingo the go-to biggest platform in the world for education. And they're trying to direct the company more in that direction. Focus on getting more users, making them more engaged. Focus on expanding the content slate and better teaching. He highlights teaching better multiple times throughout this call. They're putting a little bit less emphasis on converting users from the free account to the paid account, making it so that they can price things a little bit higher. That's not going to be something that they never do, but it's just less of their company's resources and intent and focus. So that is the gear change. That's the opportunity that this company sees. And when you look at this, you can take it two ways. Many people on Wall Street will say, well, that just means that we're going to get less bookings, less subscriptions over the next year, which means revenue won't be as high over the next year because they make money through those bookings. But that's not the only thing he's saying. He's saying part of this is a deliberate choice. If Duolingo wanted to, they could make bookings go through the roof. They could make it grow by 50% next quarter. They really could if they wanted to. But that would be at the long-term detriment of the company. And he explains how they literally have these mechanisms to determine how much they convert or how much they don't convert users from the free tiers to the paid tiers. They determine that. They can do it through all their A/B testing. He highlights very specific examples.
Some experiments improve all metrics. Great, that's an easy call. Just launch it because it improves all metrics. And that happens. But there are times when experiments improve one metric but hurt another. I'll give you a fictitious example. If right now free users get 25 energy units at the beginning of the day, and every exercise that they do spends 1 unit. If we were to do an experiment that decreases that from 25 to say 24, that's 1 fewer unit of energy per day, we know that would make us more money. That it just does, because more people run out of energy, so more people end up wanting to pay to subscribe.
So he has a mechanism right there that he knows would up their revenue. He could just turn it on at any point. Just make it so that the energy units are 24 per day instead of 25. And they'd convert far more people to the paid tier because they'd be frustrated with running out of energy. So why doesn't Duolingo just do that? Why don't they bump up revenue and give Wall Street exactly what it wants? More bookings. Well, he explains exactly why they're not doing that in this next part.
However, we also know that would decrease daily active users because it would frustrate some of the users. We've always had to make decisions about different judgment calls about this. What we mean is that the change that we are doing is that we are going to be prioritizing user growth over monetization in this type of judgment call. So in the fictitious experiment that I just gave you, we would not launch that experiment going from 25 to 24 energy units, even if it meant quite a bit of bookings gains, if it has a real hit on daily active users.
So Duolingo has these hundreds of experiments they're running all the time, testing their product on learning outcomes and behaviors and engagement, their user retention and churn, all these different things that they're constantly tuning and turning. And what they're saying is with all of these tests, they're now focusing primarily on user growth and user retention. They're not focusing quite as much on conversion or revenue. When you put this in the greater context of the direction of the company, this is a very intentional choice. A focus on organic growth and big opportunities ahead, where later on down the road, once you've gotten the opportunity, once you've really won, then you can turn the screws of monetization. That's exactly what Uber did. At first, Uber was focused on growth and they're a highly unprofitable business. But Uber grew and grew and grew to scale. They seized the opportunity ahead of them, and now they're highly profitable now that they've met scale. It was the same thing with Netflix. Netflix ran free cash flow negative so long that analysts, many of them, were convinced they could never churn a dime of profit. Even smart analysts, great ones like Aswath Damodaran, said Netflix is just a broken business model. That's what it does when a company focuses on scale and opportunity over immediate monetization. It can in many cases trick investors and analysts. And I believe that's what's going on right now. Duolingo, by the metrics, is a globally dominant company. You look at any of the metrics and it is growing like crazy. They have 11.5 million subscribers. These people are loving this product. They're using it every single day. They're growing quarter after quarter, despite all the people saying that they would not continue growing, that their daily active users would go down, their monthly active users would decline because of artificial intelligence, because of ChatGPT, because of Google Translate, because of the Apple AirPods with live translation. People said the company would die. They said that the usage would go down. They said the churn rate would go up. All user engagement metrics and numbers and usage are all going up. And in terms of the moat of the company, many people are again concerned about AI learning and AI translation. This has been one of the top concerns that I've heard about Duolingo since the very beginning. And in this call, the CEO addresses this concern head on. Here's what he says.
The two things that people say about the competitive landscape with AI are, number one, why would anybody want to learn a language with Duolingo when you can just learn it with ChatGPT? We're not particularly worried about that. We've said it before. The main thing that we do really well, not only do we teach well, but the main thing that we do really well is keep people engaged. And in order to learn a language, you need to be engaged for years. Really, it takes years to learn a language, coming every day. And we need to keep you engaged, actually doing it. And not only that, we also need to have curriculum for years for you to do that. So, with ChatGPT, you can go there and you can ask it to teach you a few words here and there. But, it's not like you can have really curriculum for years that teach that. So we're not particularly worried about that aspect. And then the other thing that people, have said that they're worried about is, nobody's going to want to learn a language because, we're going to have simultaneous language translation. And also not worried about that. I believe in 100% of the Google I/O conferences over the last 10 years, they have showcased simultaneous language translation. They do it every single year, and it's good. It works. But this has been happening for the last 10 years, and we have not seen the desire to learn a language go down at all. In fact, it has come up. And I think the biggest reason for that is because if you look at our users, they fall into two big categories. One big bucket is people who are learning a language as a hobby. It kind of doesn't matter whether a computer can do that. It's not the same with chess, by the way. Computers are way better than humans at chess, but still, we have millions of people wanting to learn chess. So it doesn't matter if it's a hobby. The other big group of people that are learning a language with us are people who are learning English, and they actually want to learn English. Like that is, for them, being able to have like a phone that they have to hold out, it just kind of, that's not what they want to do. So we're not particularly worried about that. It just so happens that people like to tweet about that, but we're not worried about it.
He highlights the distinction between Duolingo and a ChatGPT. Although you can practice a language on ChatGPT, continuing to be motivated for years on end every single day is what Duolingo specializes in. And these other companies have not done nearly the user behavior testing to have that level of engagement. The next thing is a live translation, which he accurately says is not a motivation for people to learn languages. People don't learn languages because of a lack of live translation, especially many people that are learning languages for job opportunities or for cultural reasons or for hobbies. Just like learning chess, where there's computers better than you at chess, learning a language in many cases is a hobby for people. And I agree with this assessment. I think it's an honest assessment of the differences between Duolingo and just some AI learning app. Now, Lewis goes on in this call outlining all the different things that they're doing for the future, improving their teaching, adding more courses, making it more engaging, making it so that they're adding more content to existing courses so they can teach languages to a higher level, and so on and so forth. In the chess course, for example, they're making it so that you can now have player versus player. Half of iOS users have that. They say that chess is in the millions of users already. It has retention rates better than their language learning. So they are growing a new paths with higher levels of activity. But overall, the big thing that I want to highlight with Duolingo, and I think the most important thing, is I noticed something with this company in particular. And that is that investors do what investors end up doing for every situation like this, which I think is a mistake. They let the stock price movement inform them of their opinion on the stock. Meaning, they don't look at the fundamentals, they don't look at the growth paths and the future revenue expectations or anything like that. They don't look at the valuations. They simply look at a stock price going up or going down, and they say, that is what my opinion is. If the stock went down, there must have been a reason why. Wall Street is pricing it lower. That means that the stock is doing poorly. That's what I see a lot on Twitter, on YouTube comments, all across X. I see people letting the stock price inform them of their opinion on the stock. For example, I believe in an alternate world. If you had this result and the stock price for whatever reason went up 10%, but nothing changed, not the bookings, not the growth rate, none of these metrics, I believe that most investors would look at this company and say, This was a great quarter. The stock should probably be up a little bit. And look, Wall Street is pricing it up, so it must have been a great quarter. That's the influence, the impression that the stock price leaves on you. And I think that this is a dangerous way to invest. After all, if you let the stock price dictate your impressions of a company, if you let the movements and the volatility tell you how to feel about a company, then you would not have bought Netflix when it fell 75%. You would have sold out because the panic. It really looked bad according to the stock price. Even though at the time we can look at the real damage that happened to Netflix. Let's go ahead and take a look at how bad things really were when the stock price dropped 75%. We have Netflix here. We have total subscribers. The stock price dropped 75% right there. That was it. Because this quarter right there was slightly less than that one. 75% decrease in stock price. Total obliteration. All because of those two quarters. Now, Wall Street said that Netflix was basically worth nothing because the stock was never going to grow again. They didn't listen to the management. They didn't listen to the password crackdown narrative. They didn't listen to any of the long-term thesis or thought process behind what the company's actually doing. What Wall Street thought was that this company was highly rated because of fast growth. The company's now not growing as fast, so the stock needs to come down. That's the mechanics of the market. But if you let the market inform you on how to feel about a company, you'd miss out on Netflix. And there's plenty more examples where this came from. In 2022, Amazon was trading at $80 per share. Right there, $86 per share. Now Amazon trades at $240 per share. So $80 to $240, what happened in 2022? Well, of course, it was because they're investing in CapEx for their retail growth. And that was expensive, and it caused the free cash flow to go down a lot. Investors in Wall Street looked at that and they said, oh no, we're not going to make as much money over the next year. We need to abandon the stock. Investors that looked at this as an opportunity of a company investing in its long-term future that's prioritizing lifetime value of customers and expansion over short-term profits made immense gains in that stock. I bought Amazon very close to $80 per share. I bought it under $100 per share over and over again. And that's the reason why that's such a big winner in the portfolio, is because I didn't let the market dictate my thoughts on the company. And again, these examples can go on and on. There's so many stocks that drop down for short-term reasons that if you let the stock price dictate how you feel about the company, you're going to be misled and you could potentially miss out on huge gains. And on this point, I want to highlight a story from Jeff Bezos. This is when Amazon stock price crashed by around 90%.
Amazon stock in a very short period of time went from $113 a share to $6 a share. It was very concerning, and shareholders were upset, employees were nervous. We had all of our employee base, their parents were all calling our employees and saying, are you okay? You know, this was the environment of great nervousness. But I looked at the numbers in the business, and every month, as the stock price went from 113 to 6, a number of customers went up every month. Our gross profits went up every month. Our operating expense, we were still in a loss position, but our losses as a percentage of sales went down every month. Every single business metric, new customers, customer repeat purchases, everything that we were monitoring through that entire period kept getting better. And so that's one observation about bubbles in general. The fundamentals can be disconnected, the fundamentals of the business. And of course, as entrepreneurs, you're focused on the fundamentals of the business. The stock price is an output, an ultimate output that you actually have very little control over. Benjamin Graham, the great investor, is famous for saying, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And so as founders and entrepreneurs and business people, our job is to build a heavy company. We want to build a company that when it is weighed, it is a very heavy company.
The goal for entrepreneurs like Lewis, the CEO and founder of Duolingo, is to forget about the stock price. You don't have any control over that, and that's the long-term output of what you do have control over, which is the fundamentals, making a heavy company. Now, I'm not suggesting that Duolingo is the next Amazon. I don't believe that. I'm not suggesting it. But I do believe there's an opportunity here where Duolingo could still turn out to be a pretty heavy company, one that has a massive amount of users. a really well-liked company in a very relevant industry. We've seen these type of similar companies play out. These large platform companies with hundreds of millions of users that end up growing to large established companies that in the end become very heavy companies. We've seen it with Spotify. That was a company that many people were worried about the music labels. And look how wonderful of an investment that's turned out. We've seen it with Netflix. We've seen it with DoorDash. We've seen it with Uber. All of these companies were money losing. All of them have very volatile histories. All of them have time periods where investors are super bullish or super bearish on the company. And over time, what matters is the weight of the company. Is Duolingo going to become a heavy company? Will it become a big, large, established, profitable company or not? If you don't believe it will, then don't buy the stock. If you believe it might, or there's a good chance of it, then it might be worth biting at. It might be worth one to consider. And in any case, I'd never recommend making it your entire portfolio. I'm not doing that here. If Duolingo doesn't work out, it'll be a bummer, but it's not going to impact my portfolio's performance to a massive degree. But I still believe there's a good chance for upside because, like Jeff Bezos says, I'm looking at the fundamentals. I'm seeing the metrics go up and to the right for Duolingo. As long as I see that happen, I'm not going to sell this stock. And in fact, I may dollar cost average and buy a bit more. Now let's go ahead and move on to some news. Now, amongst this big sell-off, there are a few companies that are at least holding up. Right now, Google's one of them. It's sticking in the green, just barely teetering in the green, despite the fact that the rest of the market is selling off heavily. And the QQQ, the mega caps, are selling off even more. Why is Google doing so well? Because Google has even more good news. The company said on Tuesday that the 7th generation of its tensor processing unit, the TPUs called Ironwood, will hit the market for public use in the coming weeks, after it was initially introduced in April for testing and deployment. The chip, built in-house, is designed to handle everything from training of large models to powering real-time chatbots and AI agents. In connecting up to 9,216 chips in a single pod, Google says the new Ironwood TPU eliminates, quote, data bottlenecks for the most demanding models, and gives customers the ability to run and scale the largest, most data-intensive models in existence. Now, if I was blindfolded and I just heard this line, I would think this has to come from NVIDIA. At the very least, it might come from AMD. They might say something like that. But that's not coming from NVIDIA or AMD. Now it's Google. Google is also good. They're not just good at YouTube. They're not good at robotaxi. They're not just good at cloud hosting. Now they're good at making chips. Really powerful ones that, in their words, can run the most data-intensive models in existence. How did Google get this chip so good? How did they get it so it matches performance and efficiency of top-tier chips? Well, like many things that Google does, they've been working on it for a long time. They've just been investors in all these projects for decades. The TPUs have been in works for a decade. Ironwood, according to Google, is more than 4 times faster than its predecessor. The AI startup Anthropic plans to use up to 1 million of the new TPUs to run its Claude model. If the market wasn't having a big panic attack today and selling off 2%, Google would be up 2 to 3% on this news. There's no doubt about it. Now, moving on, we get to our fail of the week. This is the second fail of the week. So we're going to have a fail of the week on a daily basis, a daily fail of the week. Don't ask me how that makes sense, but that's what this has turned into. In this case, it's Chipotle. Now, Chipotle stock is down a lot. That in and of itself is not the fail of the week. Many stocks go down for all different reasons. But Chipotle is down around 50% on the year. And it's not just the stock price. The company's also struggling. For example, even though Chipotle's opening up more locations and they're seeing some growth that way, the average revenue per location is declining, and it's been declining quarter after quarter. One of the major problems with Chipotle is very clear. Anyone that has gone there frequently knows about this issue. It is a fact that going to Chipotle to some degree is a bit of a gamble. You don't really know what you're gonna get. It's very inconsistent. And this is an anecdote from my experience, but it's also one that's shared amongst millions of people. We look at viral tweets like this. This is from Mike from Chipotle Tweets. He's tweeted that he actually did kind of like a little bit of a sting operation on Chipotle. He said that I ordered these burritos 15 minutes apart from the same store today. The one on the left I ordered in person, and it's twice the size as the one on the right, which was ordered online. My order online is always significantly smaller every time. Stop ripping us off. Off to the left, we can clearly see the burrito is almost twice as big as the one on the right. The one on the right is like a normal size burrito. The one on the left is gigantic. And again, this is not just Mike. When he tweeted this, everybody said the same thing. This has 10 million views, 144,000 hearts, 7,000 retweets. This is one of the most viral tweets across Twitter, is people saying, I know this experience. I've also gone and ordered online and I get ripped off. Now we can only speculate why the digital ordering and online ordering has such smaller portion sizes than in person. But if I had to guess, I believe it's because when you go in person, the employee feels more pressure to kind of deliver a good burrito. They see you right there looking at what they're doing. So they at least see some human connection. When it's just digitally, they go in the back kitchen, they prepare something, they don't even have to see you. They never see you through the drive-through, really. So there's not that human connection. Now, the previous CEO of Chipotle noticed that this is a problem. He even suggested going in person, and then if you get a smaller portion size than what you believe you should have, if it's a kind of a smaller portion size than what you want, you give the employee the nod. You give him a nod to get the portion size you deserve. Here he is talking about that.
One of the things I think it's great about Chipotle is if you come into the restaurant and you want a little more rice or you want a little more pico, all you got to do is kind of like, and usually our guys and women, give them a little more scoop.
Now, I don't know about you, and you may think I'm crazy here, but I don't believe that the customer should be the one responsible for making sure their burrito is made with the proportions that they're paying for. I think if you just ask for something, if you say, I want a burrito with chicken, then it should come with the right amount of chicken. You shouldn't have to give them a nod to say, hey, I really want the full amount that I'm paying for. I don't think that should be the case. And it seems like I'm, again, not the only one that feels this way. There are massive amounts of posts on this subject with tens of thousands of people, hundreds of comments all saying the same thing, that this company has a problem with inconsistent portions. Chipotle has even been sued for inconsistent portion sizes. The inconsistent portion sizes of Chipotle's food is such a big deal that one Wells Fargo analyst took it upon himself to do an in-depth study on the subject. He ordered 100 burritos from all different locations at all different times. He had the exact same order every single time. The bowl weight varied widely. The lightest bowl was 3 standard deviations below the median, meaning that this is not just an anecdotal experience. This is a mathematical certainty. Chipotle has wildly varying portion sizes with the food that they give to their customers. Management of Chipotle don't seem to know how to solve this problem. They've tried to tell their employees, hey, do better. They tried to train them better, but so far they don't have an answer. And Chipotle has taken to blaming the economy in their most recent earnings, saying our third quarter performance fell short of our expectations due to persistent macroeconomic pressures. And that certainly is a factor. I'll admit that it plays into any restaurant, but there's also a big factor that you do have control over. Even though the CEO does not have control over the economy, they do have control over how they run their restaurant. And they could get rid of this frustration that many customers deal with. And luckily for the Chipotle management, I have the answer. I have the solution. This is a really easy problem to solve. And I'm gonna lay out the answer today. This will change Chipotle for the better. When we see this implemented, you're going to have a better product, because your product will be completely consistent every single time. We can take the example of a restaurant called Mobetta's. It's a Hawaiian-style restaurant. It's a really good one. I actually love this place. So if you've ever been around a Mobetta's, go try it out. If you haven't, I think you'll like it. But we have a guy here. He's doing a food review. Like Chipotle, this is a restaurant where you have all the pictures of the food. You have all these different orders, and you go up and you assemble your food in the line. So we get to where they prepare the food. Again, you go down the line. They prepare it exactly like Chipotle's. But there is one notable difference. One thing that is just different than what Chipotle does that makes it so at this restaurant you get perfectly consistent portions of the protein every single time you go in. Let's look at Exhibit 1. We have it right here. I'll outline it in red. Right there we have Exhibit 1. That is a scale. That's a food scale. What Mobetta's does is they take your plate of food, before they put any protein in it, they put it on the scale. They hit a button that zeroes out the scale. Then they put food on to where you have the amount of food in weight that is the amount you're paying for. So as a customer, you see them pick up the food, put it in the plate on the scale, and then they have a nice little margin, right? It has to be very close, but they have a nice little margin of the amount of food you paid for. It doesn't take hardly any additional time. In fact, it takes probably about 2 to 3 seconds longer. But that 2 to 3 seconds longer ensures that you get the correct proportion of food. All Chipotle needs to do is add the scales. That's it. They add the scales and they figure out one massive problem for the business. Food scales are cheap. They're easy to implement. They're easy to train. It fixes a massive complaint for the company. It doesn't cost the company much in CapEx, and their throughput, or the rate that they can get people through the line, really isn't slowed down that much, maybe 3 to 4 seconds to ensure you get a better experience. So even though this is the fail of the week, it's also ending on a positive note. I'm glad together we could fix Chipotle. We could make it a better company, and overall we can make that unit volume grow again. Because if you know what you're getting, you're going to go there more often. That's going to be it for this episode. Hope you enjoyed. See you in the next one.